Hi, today I want to cover 6 basic keys to pursue investing success. A disciplined investor seeks to maximize their gain while minimizing their losses. But there can be no guarantee that any investment strategy will be successful, and all investing does involve some risk and the possibility of loss. Following these guidelines may help you invest more successfully. There are 2 things we can control when we invest. That's timing the markets and timing the market. It's common knowledge that timing the market can be a fool's errand, and so we're left with just staying in the market for the long haul. Of course, we can change our allocations based on the prevailing conditions, but the primary goal is to stay invested. So this brings us to the first principle, compounding. Put simply, compounding is earning returns on your reinvested earnings. The longer you leave your money at work, the more those returns start to grow. So let's say you put $10,000 into the market and earn an average of 8% per year. The first year, you'll make about $800. The second year will be about $864. And in 25 years, you'll have a little over $68,000. And by 30 years, you'll have a little over $100,000. Of course, the 8% number is an average, so over the long term, you should expect some losses, but also some years above 8%. While you should review your portfolio on a regular basis, the point is that money left alone in an investment offers a potential of significant return over time. Since we have time on our side, it alleviates the need for trying to find a home run investment in order to be successful. The second principle is about staying on track. Riding out market volatility sounds simple, but can be tough to achieve in real life. There's no denying that the stock market can be a volatile place. We sometimes have long periods where it seems like stocks just keep going up, but then eventually we find a time where it seems like they just won't stop going down. The longer you stay with a diversified portfolio, the more likely you are to reduce your risk and improve your opportunities for gain. Though past performance does not guarantee future returns, the long-term direction of the stock market has historically been up. Because of this volatility, choosing the right investments for your time horizon is important. As the horizon becomes shorter, you don't have the ability to wait out periods of uncertainty. So you may opt for lower risk investments. Whereas when the horizon is further down the road, you have the ability to take on a little more risk and ride out the bad times. Asset allocation is the third principle. This is the process by which you spread your dollars over multiple categories of investments. At a high level, this is between stocks, bonds, cash, real estate, and sometimes insurance. Getting a little deeper, usually with stocks, this is breaking up your investments among the different sectors of the economy. For example, technology stocks, consumer staples, communications, utilities, etc. The main reason to focus on asset allocation is because not all asset classes respond to the same market forces in a similar way. So when one class is performing poorly, hopefully the others are performing better and picking up the slack. This mix can help your portfolio be more insulated to market swings and hopefully maximize your returns over the long term. The fourth principle of liquidity dovetails with our previous discussion on time horizon. Liquidity refers to how quickly you can convert an investment into cash without loss of principal. Generally speaking, you'll need the money. The sooner you need the money, the wiser it is to keep in investments with much less volatile price movements. So after you've decided on a high-level asset allocation, what percentages you want to allocate to stocks and bonds, think about what your short and mid-term goals are and what needs for your cash might be, and then let that help guide you in your cash and short-term bond allocations. This way, when we experience any sort of market drop, you can rest assured that the money you need for, say, a mortgage or a new car will be readily available. Principle number 5 is dollar cost averaging. Dollar cost averaging is a benefit that mostly happens within your 401k plan by default. This is where you invest a fixed dollar amount at a regularly scheduled interval, so think your monthly 401k contribution. By investing this way, you take market timing out of the picture. Of course, some months you'll end up buying less shares at a higher price, But in other months, you may end up buying more shares at a lower price. Overall, you end up sticking with your savings goal and making sure you continually build your investment portfolio. And finally, the best thing to do is stick with your strategy. Try to resist the impulse to change your investment philosophy with every news headline or investment tip you get from a coworker. Timing the market accurately is quite difficult, even for us professionals. Hopefully, based on your risk tolerance and your ability to take on risk, you've designed a strategy that can do well in the good times, but you can also have confidence during the bad times. This, of course, does not mean that you should never adjust your game plan. At least once a year, you should evaluate your plan and see if any of your goals or circumstances have changed. If things have changed, it could be a good time to adjust how your portfolio is constructed. Also, if certain asset classes have done really well, it may be a good time to rebalance your portfolio to your target allocation. In the end, the most important factor is to continually save and invest while you have the means to do so. By doing that first step, most of the rest does take care of itself over the long haul. Thank you for your time today, and we'll come back next month with a new video. See you then.